Alrighty, welcome back to Smart Investing Show. Yes, this is where we change over and we talk to our financial planner, Harrison Johnson, who's a CFP. And Harrison, you told me quickly before the break you're dealing with underwater cars. I mean, what do cars in the ocean have to do with?
Well, the water levels are rising. Ocean levels are rising, so more and more cars are getting underwater. No, so Chase and I were talking about this earlier in the week. There was an article on CNBC that says that right now, 26.6% of trade-ins have negative equity on average.
26%. Wow, that's
26.
quarter.
So yeah, about a quarter. About a quarter of trade-ins, when getting a new car, have negative equity on that, and the average negative equity is about $6,500. Which
wow, that's a lot.
It's a lot, but I mean, when you think about, cars are depreciating assets. So you buy a car, it instantly starts to depreciate, and the trade-in value of a car is the lowest value that you can get for it. Dealerships have their own price. If you sell it to a private party, that's a different price. If you trade it in, that's the lowest price of the three. So as soon as you buy a car, if you buy a new car, finance it, don't put a lot down, it's very possible that you're not going to have equity. So on financed cars on the road today, about 40% of them have negative equity.
Underwater,
yes.
Now, do you have the key on how to fix this for people? Because
well, there's two sides of it, because on the one side, I think if you can afford a car, which that's kind of a ambiguous thing,
right.
It's relative based on the situation. I think the definition of being able to afford something is as long as you can survive and pay your bills, and then also save money and invest money to cover your future goals like retirement. Any additional income that you have is more or less discretionary. So if you want to use that to buy a car or whatever, fine. And if you are going to buy a car or any type of asset, you want to buy it at the lowest cost, which if you have the ability to finance something at a really low rate, that's might be cheaper than paying cash, even if that results in potentially having negative equity. However, I think in most cases when people are buying cars, driving for a couple of years, and then trading them in after a couple of years, they have negative equity, and then they're rolling that into the new loan. That's probably not a good situation in most cases. Right. So, but cars should last a while. My car is like 12 years old right now.
You are the exception.
Yeah.
I think you'll get every mile out of that car.
My car is now,
yeah.
Gosh, 7 years old.
Yeah, I do keep my cars a long time. I just keep buying new ones on top. So now I have like 7 cars.
Well, and again, that comes back to, you can afford it. So
right.
It's, it comes back, assuming you can afford it, you want to buy it at the best way possible, down payment, financing, and everything. But with the fact that so many people are underwater, if you're buying a car and then trading it in after a couple years, with trade-in value again is the lowest, and then you just keep financing this, usually depending on the loan to value ratio of that new car, you might not get as attractive interest rates. You might also have to get gap insurance and things like that. So it's an expensive way to buy a car.
Do you think it's people, because at that point, right, if you're continuously trading in these cars and racking up these underwater, essentially, values, shouldn't you just lease a car at that rate instead? Because then you just turn it in after 3 years and you don't have the fact that you now have $6,000 of negative equity in a car.
Potentially, yeah. Long term, I think a cheaper way to have a car is to buy a car than have it for a very long time. But that's assuming that you keep that car for a long time. But if you're going to be, buying new cars all the time and trading cars in after 2 to 3 years, then yeah, leasing might make sense. Because when you have a loan, an amortized loan on a mortgage or a car or anything like that, the first couple years are mostly interest anyway. So your principal balance on the loan isn't really decreasing that much, but that's when your car depreciates the most in value. So, the negative equity that you have is greatest in the first couple years of having a loan. So, the best thing to do is not be trading in a car, and maybe not be buying a car if you don't have enough equity, or you don't have, extra cash that you can put toward it.
And one thing I hate on car salesmen is you walk in, what's your budget? What can you afford?
What's your monthly payment?
What's your monthly
It's kind of
payment?
how life insurance is sold too, actually.
Actually, it is. It's like, I said, but it's the overall cost of everything. But they don't care. They want to get you in that car, and they don't care what happens after you leave that. What can you afford? What's your budget? Like, No, don't tell me
Doesn't
that.
matter. Yeah.
Right.
Oh, 84 months then. Yeah, we'll just stretch it out. We'll keep that monthly budget low.
Right.
You put down more money on the front side of it, and that'll lower the monthly payment too.
Yeah.
Are these things you kind of work with people to try to help them understand about?
So, I mean, buying a car is a large purchase. So, buying a house is a larger purchase, but people buy cars fairly often. And it's something that I look at because people look at, well, I'm going to be selling this car or keeping this car and buying another one. How should I finance it? How much should I put down? Which loan terms make the most sense? So this is definitely something that I look at. However, I will say most of the people I work with don't have negative equity in cars. Most of them, want to pay cash. And I'm like, well, we can get 0% financing. Let's take advantage of that.
Yeah.
So, buying cars and the best way to do that, since it's a large transaction, there's better and worse ways to do it, and I deal with it. But again, I think it's interesting that, a quarter of trade-ins have negative equity, and that's just perpetuating the problem for a lot of these people.
Yeah, just people not doing the right thing. And I think people spend more time shopping the car. They should spend more time shopping for the financing and put down less and get much better financing. You said, why pay cash when you get 0% financing? I mean, so shop for the financing.
Well, the problem is it's not going to get rid of the negative equity problem. But the negative equity problem, in my view, is not the problem, right? It's just people aren't financing it or buying it the right way. I mean, my Suburban, very large negative equity because I got 0% financing, so I put nothing down on it. It's
that's the
free
thing.
money.
But you plan on having like 5 kids, so you plan on having the car for you might be like Harrison, have it for 12 years.
Yeah, I mean, that's what I mean is the negative equity isn't the problem. The problem is that people have this negative equity and then they turn it back in at a bad price. And it's like, well, you should have just maybe leased. That would have been a better thing. But I think people think they're making the smart financial move by buying a used car potentially. And it's like, well, maybe not.
I don't know if they're trying to make a smart financial decision. I think they want a car and they're doing it just to get that car. I mean, you can trade in a car and then roll that equity, negative equity, into a new loan. You can do it. You can also carry interest on a credit card. It doesn't mean you should. Yeah. So,
and I think you said none of your clients actually have negative equity in the car, or in that.
They might have negative equity, but I've never seen any of my clients trade in a vehicle that has negative equity. Yeah.
And I was going to say that's because they come to you because you're smart as a financial planner, and they're smart going to a financial planner, really understand their finances better than just saying, oh, yeah, my budget is this. Okay, I'll just buy this car. Getting too much car, more than they need, roll it over. I mean, all these crazy things people do.
Yeah, and I mean, when you think about it, car payments can be $500, $800, $1,000 a month for, a normal-ish car.
Right.
That's a lot of money that you can be applying toward a retirement account. So if you got 2 car loans, you're making payments. Yeah, it's tough to get ahead, and that's kind of back to the question of can you actually afford this? If you can't afford it, if you're not saving for retirement, having the discretion to buy a nicer car all the time is more of a luxury. Prioritize, the things that actually matter.
I had a client ask me, he goes, I did this. I put a lot down, and I got this high loan. Did I do the right thing? No. You should have asked me before you did it.
Well, that's another thing, too. Yeah, people do things. They're like, yeah, I did this. It's like, well, we could have done this. But a lot of times it's just little tweaks, but they make a big difference.
And if you're a financial planning client, they call you, they can ask that question before they buy the car.
Hopefully they do. I tell them. I mean, some people are like, well, I don't want to bother you. No, please bother me. That's what I'm here. Before you do something, let me know about it, and maybe I'll say, yeah, continue to do it that way, or let's do it this way instead.
If they call you, maybe they won't be rolling over negative equity when they get a new car.
Hopefully not.
Great information.
All right. Thanks,
Harrison. All right. Again, that's Harrison Johnson. He's our financial planner at Wilsey Asset Management. If you want to contact him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. You can send him an email. Go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com.